China just halted all outbound investment into US-based companies. Not some, all. This didn't come with a press release or a press conference. It was leaked, buried in regulatory filings, then quietly confirmed by outlets like Reuters. Here's the timeline. March 17, 2025, China's State Administration of Foreign Exchange issued a confidential directive suspending all non-essential capital flows to what it now calls hostile jurisdictions. The United States? Yeah, it's on that list. This followed a quiet update from China's Ministry of Commerce labeling US-bound investment as officially suspended. Effective immediately. That's right. No phase-out. No soft landing. One moment the money was flowing. The next, dead stop. Now, Chinese capital in the US had already been dropping. In fact, since 2018, it fell over 95%, from $46 billion down to just $2.3 billion. But now, it's officially at zero. $1 trillion in assets and long-term deals just evaporated. But here's where it gets really strategic. According to economists like Professor Zad Daojiang from Ping University, this wasn't some emotional overreaction. This was calculated. A pressure point move. See, China wanted to exert maximum capital leverage on the US without directly provoking a retaliation. Think of it like cutting the fuel lines in a race. The car doesn't crash immediately, but it can't win either. The move hits especially hard now, because even while trade still continues, Beijing has been quietly pulling away from US economic exposure in all directions. Let's talk specifics. In 2024, China sold off $14 billion in US Treasury bonds. That's their biggest single-year dump since 2016, bringing total holdings down to $775 billion. At the same time, state-owned Chinese banks stopped doing dollar-based transactions with US banks, following new compliance rules from the People's Bank of China. US Commerce Secretary Gina Raimondo said it best. China is restructuring its financial exposure in ways that sharply reduce our leverage. In Washington, it's struggling to respond. Export bans and tariffs are too slow. The capital is leaving before policymakers can even react. Here's what should really keep you up at night. The money isn't just sitting on the sidelines. It's moving, just not to us. European companies are suddenly getting a lot more love from Beijing. Some are even lobbying to work around US financial rules entirely. And that's causing ripple effects. Foreign direct investment, FDI, into the US dropped 22% in 2024, according to the UN Conference on Trade and Development, UNCTAD. Early 2025 forecasts, another 19% drop. That's not just China pulling out. Other major players are following suit. Norway's sovereign wealth fund just yanked $7.1 billion out of US tech stocks. Reason? Regulatory instability. Japan's GPIF, the world's biggest pension fund, cut its exposure to US commercial real estate by 30% after Moody's downgraded several regional banks. And with $4.1 trillion in US corporate debt due by end of 2026, that sudden absence of foreign capital is more than just inconvenient. It's dangerous. Companies now have no choice but to borrow domestically and at higher rates. Here's what that looks like in real life. In 2024 alone, over $430 billion in junk bonds were issued. That's up 38% from the year before. The average yield, 9.6%, nearly double what it was in 2022. Let's take one example. Boston-based manufacturer Hartwell Tech had a $180 million Chinese-backed equity deal vanish overnight. Left scrambling, they turned to Apollo Global for a bridge loan. The interest rate? A crushing 11.3%, and they had to secure it against their intellectual property and real estate. That's survival mode financing. It's like taking out a payday loan to keep your business running. According to Fitch Ratings, 1 in 5 mid-sized US companies faces serious refinancing risks in the next 18 months. Remember all the talk about reshoring, bringing jobs and manufacturing back home? That was supposed to make us less vulnerable, right? Well, it's hitting a wall too. In 2025, Trump signed an executive order expanding tax credits to encourage reshoring. But even with incentives, 62% of companies say they're struggling with funding gaps. Why? No foreign partners. Projects announced in 2023 with partial Chinese or Taiwanese funding, like an $8 billion battery plant in Michigan, a $3.1 billion robotics hub in Nevada, have either been delayed or canceled. Even the CHIPS Act isn't immune. Intel's $20 billion Ohio chip plant, meant to be a symbol of American independence, is now pausing construction on Phase 2 due to funding issues. Economist Ishwar Prasad put it bluntly, without diversified capital, these initiatives risk becoming symbolic instead of transformative. And as domestic supply chains rebuild, guess what happens? Costs go up. And those costs? They're hitting your wallet. Trump's new 2025 tariff package now affects over $500 billion in Chinese imports, up from $370 billion in 2020. The average tariff? Now at 22%. What does that mean for you? Appliance prices are up 16.7% year-over-year as of Q1 2025. The National Retail Federation says the average U.S. household will spend $1,950 more on goods this year because of these tariffs. Companies like Walmart and Target have already issued back-to-back margin warnings, blaming direct tariff exposure. And here's the balancing act. Do they eat the cost and lose profit? Or pass it to the consumer and risk demand collapse? Neither choice is good. Meanwhile, real wages are flat. Inflation is still above 3.6%. And S&P 500 earnings for Q4 2024? Just 1.2% growth, down from 4.5% the quarter before. This all feeds into something even more serious, a crisis of trust. The Economic Policy Uncertainty Index, a tool developed by Baker, Bloom, and Davis, just hit its highest level in over a decade. Higher than during the COVID lockdowns. Higher than the 2008 crash. CEO confidence has cratered. The Conference Board's index fell to 37 in March. And 68% of business leaders now say erratic U.S. policy is making it impossible to plan long-term. It's not just about interest rates or inflation. It's about unpredictability. Bank of America analysts nailed it back in February. Capital isn't stalling because it's too expensive. It's stalling because it's too chaotic. And investors are responding. In the last 90 days, Bloomberg reports over $120 billion has been pulled from U.S. equity ETFs. And here's where it gets uncomfortable. Even America's closest allies are starting to hedge their bets. Germany's Chancellor Merz visited Beijing in February. Right after that, BASF doubled its $10 billion China expansion. France signed a new LNG deal with $0 involved. It's fully denominated in Chinese yuan. The European Chamber of Commerce in China says capital inflows to mainland industrial zones jumped 19% in Q1 2025. Why? The number one reason cited? Policy consistency. Even Saudi Arabia is shifting gears, pulling out of U.S. treasuries and putting $27 billion into an AI fund with China and Singapore. As former IMF chief economist Kenneth Rogoff put it, the U.S. isn't losing its influence. It's losing its gravitational pull. Allies aren't abandoning America out of protest. They're just trying to protect themselves from instability. And China? It's not demanding loyalty. It's offering something arguably more valuable, stability. Now here's the final piece of the puzzle, and it's huge. China isn't just pulling money out of the U.S. It's building a whole new financial map. The China Securities Regulatory Commission is fast-tracking foreign IPOs. In Q1 2025 alone, 38 new listings, a 52% jump. China's sovereign wealth fund increased its ASEAN debt exposure by $19.4 billion, according to a leaked HSBC report. And maybe most importantly, the digital yuan is now being used for international settlements across 13 countries through a SWIFT Lite system. That means cross-border trade without touching the US dollar at all. As HSBC's Harold Wong says, this isn't about replacing the dollar overnight. It's about making sure it's no longer the only option. So, what if this isn't a freeze, but a flare? What if Beijing isn't just retreating, but signaling a whole new economic reality? A world where the US can no longer assume capital will keep flowing in. Where reshoring becomes unaffordable. Where allies stop defaulting to the dollar. And where economic leverage slips, not with a crash, but with a quiet, calculated drain. We're not there yet. But this moment? It could be the beginning of something much bigger. If you're finding this breakdown helpful, hit that like button, share it with someone who needs to see it, and subscribe for more insights on the shifting global economy. Because this story? It's only just getting started.